Welcome to Investors Insights, episode number 140. Today we will be discussing, will Yellen raise Fed rates? How will your portfolio be impacted? Will oil prices continue to collapse, but you'll smile at the gas pump? And in addition to that, we may actually point out where we've been right, as well as maybe where we've been wrong. And if you like what we have to say, don't hesitate to let us know. Send us emails, give us feedback, give us that phone call. And if you don't like what we have to say, we know you probably will let us know. But in addition to that, don't hesitate, because we love to hear from you and your opinions, your ideas, and feedback. So let's get started.
I'm Greg Powell, and this is Investors Insights.
You're listening to Investors Insights with President and CEO Greg Powell and the Portfolio Strategy team at Five Plan Partners.
Rolling 3, 2. All right, guys. Last week was not dull. We had this debate this morning. Pretty eventful week last week. This week's got big news with the Fed possibly raising rates, although I think we feel confident we're going to see something. So, Bobby, why don't you start us off? Just kind of recap last week for us.
Well, last week was pretty rough in the markets as oil was a massive concern. I mean, oil continues to go down and tumble. Also, unemployment.
I'm sorry. What'd you say? Oil what?
Oil is not looking good. It's not looking good.
Now, I think we said at the beginning of this year that oil would collapse. Did we say that?
We did.
For those of you, I'm coming back at you. We told you so.
Yeah.
Right here.
Definitely.
Just say it.
Yeah.
All right. So, unemployment?
Yeah, so unemployment hit a 5-month high in terms of unemployment claims. Now, as long as we stay below the 300,000 level, it's still considered a healthy employment, and so that's pretty good.
But what have we said about unemployment? We have said that unemployment was going to continue to be an issue because technology is replacing jobs.
Yes.
And every time the Fed thinks they've got it under control, technology is going to come in and disrupt the business model. So that's going to be a running theme into next year. Agreed?
Agreed.
Okay. All right.
Also, rail traffic was down 6.6% last week. Now, rail traffic is interesting in that it's Warren Buffett's leading indicator. And so that's trending in the wrong direction. Right. And so with all the negative news going on, where's the good news?
Yeah, well, let's bring that up about Warren Buffett, though. The Berkshire Hathaway is down, what, 10%? 10% this year?
Actually, yeah,
that's the return on that. And Buffett has always been a believer. And here at Five Plan Partners, we not only, in terms of tracking the railroads, but also the truck industry.
Yeah.
Yes. If people aren't placing orders...
Right, it starts there.
Exactly, and usually starts 90 to 120 days out. True?
Yeah,
true.
Yeah, absolutely.
All right, sorry to interrupt.
And so, there is good news out there. So outside of manufacturing and the energy sector, our economy is still looking pretty strong here.
Okay.
And so to finish off the year, the second part of December is usually the best time for the market to go up. And so obviously you talked about it earlier, the showstopper this week is the Fed. And what are they going to do Wednesday, raising rates or not?
Right, so, that's exactly right. Will Yellen make the market yell? I mean, that's it. But will it scream? We like a cheer, or will we get a scream? Right? Right. Yeah. Okay. So, and we think we're going to. It may be a non-event.
Right. Yeah. I think it seems to be priced in mostly.
Okay. Now, actually, you were pounding on the table earlier this morning about the Fed rates. What? Give us those thoughts.
Yeah,
with the same passion that you.
Yeah, the interesting thing is where it's been so problematic for the Fed is on the inflation side. We have a dual mandate with our Fed. Many countries don't, and that is it goes to inflation and unemployment. The employment's been pretty predictable, but the inflation has been extremely difficult to measure since the financial crisis.
Okay.
And we were looking at this from 1992 to 2007. The average inflation rate was like 2.038, right on target. That's the Fed's target. And they've always used macroeconomic theory like, as we know, what's called the Phillips curve. And that's the relationship between unemployment, how interest rates move, how wages move. And that came out of a British economist in the 50s. That's been very predictable for the Fed over the years, from Volcker to Greenspan and Bernanke forward. However, after the financial crisis, that key modeling to predict inflation has just not been as reliable.
But part of that could be due to the fact the whole technology,
exactly right.
Aging population. For those of you that have been watching our vlog, or if this is your first time, you need to keep watching it, because earlier this year, what did we say about inflation?
Oh, absolutely.
Yeah, we're fighting deflation.
We're fighting deflation.
Absolutely.
Yeah. So the point being is, again, here, when somebody says to me, I know markets and portfolios can bounce around. Greg, what were you thinking? What were you guys thinking? The point being is, a lot of these things we talked about at the first of the year are now really becoming reality.
Yeah, they are.
Okay.
Yeah.
And in terms of our portfolio,
We use the analogy of a sports team like the Fed. If you've got a great sports team with a key athlete and you're doing well, and all of a sudden that athlete gets hurt, you got to figure it out again.
Right.
And the metrics of inflation have been very, very difficult to get around.
Yeah, they've got to readjust their game plan.
Yeah, they do. Well,
that's exactly right. Right. And Trey, bring up the points you brought up in the meeting as well.
Yeah. So on the eve of the Fed raising rates, last week we started to see one of the downsides of low rates for long. We're seeing kind of the unintended consequences. What has happened is as rates have come down, it has pushed individual investors kind of out the risk curve and into more kind of less liquid, more risky and higher yielding investments. We saw last week the high yield junk bond market kind of seize up. What that is that means it's harder to sell, and when you can't sell, buyers get more power, and they'll give you much lower prices if you have to sell. This kind of has two impacts. Historically, when you have illiquidity in the market, that expands and hurts the economy as a whole. Now, what's happened is that the Fed seems to have pushed people out the risk curve, but then on top of that, there's also the Dodd-Frank law, which limits what banks can hold on their balance sheets. So that has caused less liquidity because they used to hold all these bonds, and they would be the buyer of last resort. Well, without that liquidity, now it may be hurting individual investors that are in these specific kind of more esoteric, kind of risky, illiquid assets. It may hurt them because there's not the liquidity. However, in terms of how that impacts the whole economy, it's less spread, less likely to spread because it won't impact the banks because they no longer hold these illiquid assets.
Well, and on that note, Friday we saw the market take a big drop, but that drop, part of that was knee-jerk reaction to this one particular fund, correct?
And all bonds aren't created equal. You see the junk bond market seizing up. The Treasury market zoomed high. I mean, the rates zoomed down, but your prices zoomed higher.
I'm sorry, Trey. What went up?
Treasuries.
You're talking about the treasuries that we have in our clients' portfolio's?
I'm talking those exactly.
I mentioned
which is wild.
I've had plenty of discussions here recently, Greg. Rates going up.
Yeah.
Why would you buy treasuries?
This is why. Not all bonds are created equal. You see the short end of the curve going up again, long end going down. That's risk off because these junk bonds are more liquid. There's nothing more liquid than treasuries.
That's exactly right. So there is a need for treasuries in the portfolio at this time. Agreed?
Yeah. Agreed.
Okay.
That's what we're
saying. All right.
saying.
Well, that was a great explanation. And it also brings up the fact that with the market trading back the way it did, we fully believe the market's oversold at this point.
Yes.
We've got a few items and topics, as we've discussed, to get off the table this week. But still think that there's a good opportunity in the good old USA markets. True?
True.
Absolutely. So on that note, we are entering the holiday season. We hope you understand that while you're out there holiday shopping and taking care of different things, that we're watching the portfolios. We're going to keep you updated. We're thrilled to be working with you. And for those of you that aren't clients that are watching this vlog, please get in touch with us if you're not having this kind of dialogue with your financial advisor. And last but not least, we treasure opinions. And as I said at the beginning of this vlog, send us your opinions, ask your questions. We love the debate, and we hope you have a great week. Thanks.
More information at fiplanpartners.com. Securities offered through LPL Financial, member FINRA, SIPC.